Every year, millions of Americans contribute to their 401k plans, diligently setting aside a portion of their hard-earned income for retirement. But have you ever stopped to think about where that money actually goes? According to the Investment Company Institute, ICI, in 2020, a staggering $8.3 trillion was invested in the U.S. stock market alone. And what's even more astonishing is that a significant portion of this money comes from your 401k plan. As you diligently contribute to your nest egg, it's likely being managed by one of the four largest 401k providers: Fidelity, Vanguard, Schwab, or Wells Fargo Advisors. These behemoths manage trillions of dollars in assets for millions of Americans. But have you ever wondered what happens to that money after it's invested? Does it go directly into the companies you're betting on through your retirement account? Think again. In reality, a significant portion of 401k contributions are being used by these giant fund managers to line their own pockets. Research from the Securities and Exchange Commission, SEC, reveals that in 2020, $14 billion was paid out in management fees to firms like BlackRock, State Street Global Advisors, and Vanguard Group. That's a whopping 17% of total assets under management. Meanwhile, Wall Street titans like Goldman Sachs, Morgan Stanley, and Bank of America Merrill Lynch are raking it in from trading commissions on your retirement savings. According to data from the Financial Industry Regulatory Authority, FINRA, in 2020 alone, these firms earned over $10 billion from trading activity tied to 401k accounts. It's a mind-boggling reality that few people seem aware of. The very system designed to help you save for retirement is being used to enrich Wall Street. But don't just take our word for it, we're about to blow the lid off this secretive world, exposing the shocking truth behind how your 401k is really funded every year. As we delve into the world of retirement savings, it's essential to understand the sheer scale of investments made in the U.S. stock market. In 2020, a staggering $8.3 trillion poured into the market, with a significant portion coming from individual investors through their 401k plans. To put this number into perspective, that's equivalent to approximately 35% of the country's GDP. For many Americans, their 401k is a vital source of retirement income. In fact, according to a report by the Employee Benefit Research Institute, EBRI, in 2020, 46% of working adults contributed to a 401k or similar plan, while 23% were participating through an employer-matched account. That's a combined total of around $1.5 trillion annually. As your contributions accumulate over time, they're invested into various asset classes, such as stocks and bonds, in the hopes of generating long-term growth. However, what happens to this money after it's deposited? Where does it actually go? The truth is that a significant portion of 401k funds are not being used for its intended purpose, providing retirement security. In reality, much of your 401k investment goes towards supporting existing companies and industries, including those involved in the manufacturing of military equipment, fossil fuels, or pharmaceuticals. Many top 401k fund managers have been criticized for investing heavily in such sectors, often without disclosing their true intentions to plan participants. A recent investigation by Bloomberg revealed that BlackRock, one of the world's largest asset managers, has significant holdings in companies involved in the production of tear gas canisters and other non-lethal munitions. This raises questions about the true alignment of interests between investors like you and the corporations your 401k funds are supporting. As we continue to explore this complex web of investments, it becomes clear that the story behind your 401k is far more intricate than initially meets the eye. The $8.3 trillion invested in U.S. stocks is not just a number, it represents a vast network of financial interests that intersect with the broader economy and societal values. As we dive deeper into the world of 401k plans, a crucial development in the early 2000s laid the groundwork for the massive investments that followed. In 2004, Congress passed the Pension Protection Act, which included provisions aimed at increasing retirement savings and encouraging companies to offer more robust 401k plans. One key provision allowed employers to claim tax deductions on their own contributions to employee 401k plans, a move that incentivized them to contribute even more to these accounts. This led to a surge in employer matching, with many companies increasing their matches from the traditional 50% of employee contributions up to 100%. But what's even more striking is the impact this had on the overall investment landscape. According to a report by the Securities and Exchange Commission, SEC, between 2005 and 2019, 401k plan assets grew from $2.3 trillion to over $24 trillion. That's a staggering increase of over 1,000%, with millions of Americans pouring their hard-earned savings into these plans. It's worth noting that the largest 401k providers in the U.S., such as Fidelity and Vanguard, have become behemoths in the financial industry. They manage trillions of dollars in assets and command significant fees from plan participants. But where does this money go exactly? We'll explore some disturbing answers to that question next. As we dive deeper into the world of 401k funding, it's essential to understand that a substantial portion of these investments is channeled through a complex network of intermediaries. The Investment Company Institute reports that in 2020, over $6 trillion was invested in actively managed mutual funds alone. Now, you might wonder what happens to this massive sum after it's invested. According to a study by the Securities and Exchange Commission, nearly 90% of these investments go towards buying existing stocks on public exchanges. But here's where things get even more fascinating. A significant chunk of these investments is directed towards proprietary trading desks. The term, proprietary trading desk, might sound innocuous, but in reality, it refers to a special type of trading platform operated by large financial institutions like Goldman Sachs or Morgan Stanley. These desks use money from 401k plans and other investment vehicles to take highly leveraged bets on the stock market. The problem is that these proprietary trading desks often engage in high-risk strategies that can have far-reaching consequences for the entire economy. For example, during the 2008 financial crisis, it was revealed that several major banks had engaged in a massive derivatives scheme using their proprietary trading desks. This led to billions of dollars in losses and ultimately contributed to the collapse of Lehman Brothers. The implications are stark. With trillions of dollars flowing through these complex networks, even small miscalculations can have disastrous consequences. It's imperative that we understand how our money is being invested and demand greater transparency from financial institutions. As we continue to explore this topic, we'll uncover more shocking truths about the inner workings of the 401k system and its impact on our economy. As we've established, your 401k plan is a massive contributor to the U.S. stock market's astonishing $8.3 trillion investment in 2020. But what you might not know is that a significant chunk of this money isn't actually going towards buying stocks or bonds, it's being used to prop up the very same financial institutions and corporations whose interests they're supposed to represent. A closer look at the 401k plan reveals a system where administrators, custodians, and other middlemen siphon off tens of billions of dollars each year. In fact, according to a study by the Investment Company Institute, in 2020 alone, the fees associated with running these plans totaled over $43 billion. Now, this might not seem like an outrageous amount, but when you consider that it's being taken out of your hard-earned retirement savings, it starts to look very different. To put this into perspective, if we assume an average 401k plan participant contributes around $10,000 annually, that means these fees are eating away at nearly a quarter of their contributions. But the issue goes far beyond just the dollar amounts involved, it's about who benefits from this system. Research by investment firm Fidelity shows that in some cases, as much as 90% of the average 401k plan participants' investment portfolio is allocated to just 5 major corporations: BlackRock, Vanguard, State Street Global Advisors, JP Morgan Chase, and Wells Fargo.
These behemoths of finance wield immense power over the stock market, shaping trends and influencing policy decisions in ways that often